All right, Beds, we're back for another episode of the Mortgage Show. How you doing, pal?
Not gonna lie, buddy, I'm feeling it right now.
Are you? You look like you're feeling it. Hair's looking good.
I started working out again. I'm eating like a bird again. It's time to start taking life serious again. You know, we do need to talk about something right off the top. The future draft capital that you're giving away in our fantasy football league to only finish second to me this year when I win the thing.
You know, I was telling you in text, I hope you get the feeling someday that I've had of winning a championship in this league. It's something I'll never forget. I don't know that it'll be this year, but I hope you get that feeling someday. It feels really good.
You've got two, right?
Dude, undefeated season, then one a couple years ago, so kind of a legend. It's no big deal.
You're sneaky in the area of the one that we've been in together forever. You have like the worst luck, and I've had some semi-decent luck. And so I've overlooked the fact of how dominant you've been in this one. So
yeah, it's funny because the other one that you're talking about with bats and bad luck, bad teams, that's the one I want to win the most. So like, I think I'm pressing in that one.
Do you realize I think you beat me for the first time in 12 years a couple weeks ago?
Did I? Nice. That's good to know. It feels about that way. So again, it happens.
So we've got some fantasy football stuff to start today, but let's get down to brass tacks. Let's do some mortgage stuff. Should we?
So my thinking today was build a little campfire. Chris and Randy tell some stories around it of some loans that we've had, some news that has come out in the mortgage industry, some things that we've picked up in the past month that might be beneficial to the realtors, the referral partners, the customers that we work with that might listen to this. And then we're going to bring on Uncle Tony back half of the podcast to talk about interest rates. Why don't you give a little quick background on Uncle Tony?
Uncle Tony, uncle because of marriage. So this is my wife's uncle. He ran a bunch of credit divisions for Citibank. Really awesome human being, but I mean, the knowledge that he has of the market is something that I really draw to when we're in conversation. So it's going to be fun to have him on just to kind of get some of the technicality stuff that he sees in the market and where he sees rates going. We talked maybe a little bit about what his projection is on real estate. So I think you guys are going to enjoy him.
Yeah. I've actually never met Uncle Tony, but you've talked a lot about him. So I'm looking forward to having him on because I know that interest rates and the economy and all that stuff is kind of his realm. So we'll save that talk. We talk about it every month, about what's been going on with rates, what we think is going to happen. But let's save that talk for Uncle Tony. And then why don't we just dig into some stories that we have or some things that have come out in the past month. Did you want me to go first?
Yeah. Throw the first log.
So the first thing that I want to talk about is the idea of appraisal waivers. So appraisal waiver is when we do a loan for somebody, conventional loan. We run a loan through this automated software that Fannie Mae and Freddie Mac provides to us and to all lenders. It's not a CMG thing. And when we run it through, it analyzes the loan, gives us an initial approval, but it also tells us if we need an appraisal or not. So over the past few years, we've gotten a lot of those appraisals waived. And whenever an offer goes in, a realtor's always like, hey, do we get an appraisal waiver? Do we get an appraisal waiver? And that's something that we're happy to check. But up until this month, the borrower had to have at least 20% down in order to even have a shot at getting an appraisal waiver. And even if they had 50% down or 75% down, the biggest factor is whether or not the mortgage that's on that property is a conventional loan that Fannie or Freddie held, or there's ever been one in the past. But anyways, borrower has to have at least 20% to even have a shot at getting that appraisal waiver. They've lowered that to 10% down, which opens up a bunch more opportunities for people with lower down payments to also get appraisal waivers, which I think is pretty exciting.
It's interesting because it's like I've been sort of projecting a little bit of a downturn in the market, and you could see with the smarter people in the room, they're viewing risk a little less than what I'm thinking the market is heading towards.
Yeah,
just from the standpoint of they're willing to do 10%. So that's a big thing, actually, I think. And I don't know how I feel for the appraisers. It's nice for us. It makes transactions go way faster, but you got to feel a little bit for some of that business going away from appraisers, but it is what it is.
It is a bummer. We obviously have some appraisers in our life that we're close with and hate to see their business change. It's inevitable that businesses change. Ours certainly has changed a bunch since we've been in it, and this is part of the change that's ongoing for them. It is a good thing for the borrowers, man, in my opinion, right? They save the cost of an appraisal, $700 to $800, depending on the circumstance. Definitely makes for a smoother transaction instead of having to wait a couple weeks for that report. We just know that it's off the table. in my opinion, it should give the buyer some confidence in the price that they're paying, that Fannie Mae, Freddie Mac feels comfortable waiving the appraisal, at the price that we put into the software. Otherwise, if Fannie or Freddie did not feel comfortable and they thought that you were stretching for the purchase price, they wouldn't waive the appraisal, So anyways, I think it's a good thing all around.
They have this, behind the scenes, I think it's something like they own 80+% of the mortgages in the United States. So they've got a large database. They have all this appraised value stuff, whatever their algorithm is. And it's as simple as when we trigger a waiver, it's more probable than not that the value is being derived from a house 3 houses down the street that's backed by Fannie or Freddie that just had an appraised value to it. So that's basically where it comes from.
Yeah. And honestly, they've been building up all this data like you had said. So one of the biggest requirements to get an appraisal waiver is the fact that Fannie Freddie had a loan on this specific property that had an appraisal done, and all of that information in terms of square footage, bedrooms, bathrooms, all that stuff is in some database someplace. So they can look at that purchase price, know the data on the building, know the data on the house 3 doors down, and just say, yep, you're good. That price is good. And it's probably going to continue to move that way over time. I wouldn't be surprised if that requirement dropped below 10% to 5% at some point. And at some point, maybe every conventional loan will have an opportunity to get an appraisal waiver if the value is where the software thinks it should be.
The computers are taking over. They're going to take our job soon.
I agree. It's been a good run.
It has been a good run.
It's been a good run. We got maybe another couple of years, so we'll see what we can squeeze out of this business. What do you got? Anything that come across your plate this past month?
Yeah, I like the non-QM option that I just closed for a self-employed borrower, not with 2 years as a self-employed borrower or company. It was really neat where we're actually 16 months into this new business, and they actually even haven't filed year 1 of tax returns yet.
Mm-hmm.
So they're on extension. I don't want to call them a mess, but they're so busy with their job. The bookkeeping's there. They just haven't gotten it to where the taxes have been filed. But how did I do this loan? So non-QM, we did 12 months of business bank statements. So we took the deposits coming in. So we used the gross of those deposits. There's an expense ratio factor to it. The borrower had a 740 mid FICO score and they had 35% down. So this was a sell buy scenario, same day. And we got the job done, man. It was. So these non-QM loans, they're brokered out. So we have a dual license at CMG. We offer our own stuff retail, but we could also broker out to these non-QM lenders. We also have some banks, local banks, stuff like that. But it's different where the control was a little bit out of my hands because it's like CMG to CMG. There's relationship there. There's accountability there. My experience was great. It's just, it was a little bit of nerve-wracking process to get it through, but I dominated it. They dominated it. And we got the deal done. So
love it. Just so we're on the same page, non-QM loans are just for those non-traditional situations, which would be a bank statement type scenario. And you said borrower is a mess. I know you don't really mean they're a mess, but they're just like any self-employed borrower that we encounter, or at least a lot of them, where they're so busy in the day-to-day operation of their business that the books get set aside when they file their taxes. The only thing they're concerned about is minimizing the amount of taxes they have to pay to the IRS. So their income is low. Not this particular situation because they didn't file, but like the one that I'm doing like this right now, closing in a couple weeks. Guy makes plenty of money, but he's always just kept his taxable income really low to minimize what he pays to the IRS, writes off a ton of stuff. We do this bank statement program, makes like 15 grand a month with the calculations that they use with the money going into his account, way more than what's on the tax return. So they're great options that we're doing more and more of, which is cool.
It's nice. A qualified mortgage meets 6 pieces of repayability. What is a non-qualified mortgage? It's a loan that does not meet the 6 pieces of repayability. So that's why you put it in that bucket. And like Randy mentioned, a bank statement program, that's not part of the 6 pieces. We need bank statements for qualified mortgages, but in this case, we just use the deposits. So it's a really neat option. It brings me back, Randy. I'm going to age myself. I hate doing this, but I'm at that point. Dude, 20 years ago, we were doing bank statement loans.
Yeah.
They were referred to as subprime loans. Now they're non-qualified loans.
That was prior to me being in the business, but I've definitely heard the stories about them. Yep. Subprime certainly has a bad connotation that goes along with it.
Yep. But back then, the down payment requirements were as low as, I mean, we had some no money down loans for these bank statement loans. Now you have to put skin in the game. So it's not like you're just showing up and getting a home.
Like you said, this borrower is doing 35%. So good stuff. All right. Thanks for sharing. I am going to move on to some Maine State Housing news, which I think was pretty big. You probably know what I'm going to bring up, but for the longest time, and it goes with like RD loans as well, you can do a Maine State Housing loan, there's an income limit. And it's always been that Maine State Housing is going to view the income for all the people that live in that household, regardless of if they're going to be on the loan, towards this income limit. So, if you had one borrower that had the good credit and we're going to do the loan based off of them, and then you bring in their spouse who doesn't have the good credit, we're going to leave them off. But when you add their income, it puts them over the limit. That would be a problem. And I ran into that countless times, since I've been in the business. But just this past month, Maine State Housing made the announcement that they're no longer going to count income from borrowers not on the loan that are in the household towards that income limit. So it makes things so much easier now, because we used to have to verify employment for borrowers that aren't even on the loan. They're doing nothing, have nothing to do with the actual loan, but we're getting verification of employment and pay stubs and writing letters saying that they're staying home watching their kids. All that stuff doesn't matter. It's just like every other loan that we do now, where it really only matters what the income is of the actual borrower and how that contributes towards the income limit. So I think it's a good change. It's going to allow more people to get Maine State Housing loans, which is a good thing.
You wonder why they pivoted from that.
Well, in their announcement, they said they made the announcement sound like they're just trying to mimic what other loan products do. And there's no other loans where there's an income limit that you would count people that aren't even on the loan towards that. Like say you had a mom that needed to buy a home and she's right up under the income limit, but she has a 20-year-old son that lives there. We have to count his income, and he might have a part-time job, but it like puts him right over. Like, that's not right. Like why would we penalize the mom for, the fact that the kid lives with her and has a job that puts them over the income limit when he's not even on the loan? So it's going to help people out that are on that fringe situation be able to use this program, because Maine State Housing is a great loan. And the income limit is the thing that people encounter a lot that prevents them from doing it.
It really put people in an area of like, do I disclose that this person lives in the house?
People want you to do that, right? They're like, I'm not even married to this person. It's my girlfriend or something like that. And it's like, oh God,
Something sneaky too about the median income limits. Mm-hmm. York County has two separate ones. So we've got this sort of Biddeford, Saco, Kennebunk, Buxton, Dayton, Hollis, that cluster there with one income limit. If you're looking to buy in York, Berwick, what's the third one? York?
Elliott. I think it's South Berwick, Elliott, Kittery, and York has like a much higher income limit as you get closer to Seacoast, New Hampshire.
So I think it's important to mention that, because it actually gets more borrowers in loans. So that's a good little wrinkle.
I will say that at least me personally, have done more Maine State Housing loans than ever this year. It's a great program. We've probably talked about it on the podcast, but there's different variations of Maine State Housing. But the big one that people do is this rural development one, where it's, again, no money down. But if first-time home buyer, you can get $5,000 towards your closing costs. If you're a veteran, you get $10,000 and an even lower rate. So there's a bunch of variables. Maine State Housing is a great loan. So the fact that more people can do it's a good thing.
Yep, agree.
So, all right, what else you got?
What else do I have? It's funny. I'm living in the non-QM area right now. I just closed, though, a 203K, which it's been so long, man, since I've done a 203K. I like that the market's moving back into an area where borrowers can purchase plus improvements. So we have some government options in this area. We have VA, we have FHA, rural development will do it. We have a conventional option. So I got to tell you, I liked, and you've experienced some construction loan scenarios. I know you've closed a few.
Yeah.
Our construction/rehab department is money.
Yeah.
Like, it's nice. They take it out of our hands. They go directly to where they need to be to get docs. It's a really simple process. So I got through one of those recently, and that was pretty cool. I think, Randy, it's probably been 10 years since I did my last one.
Yeah. Well, it's good, man. You get a taste of it, and you see how easy it is at CMG to do those, and it just gives you that much more confidence to talk about it with people you work with. The hardest part of those type of loans is the coordination of quotes and bids and insurance and all that stuff from the builder that our borrowers are working with. A lot of these people like other self-employed borrowers, are so busy doing what their job is, they don't want to deal with quotes and breaking it down the way that we need it and all that stuff. So our renovation / construction team is willing to take that off of our plate, take it off of our borrowers' plates, and work directly with the builder to get everything we need. And it really makes things a whole hell of a lot easier.
Yep.
So
You have a VA one, yes?
not new construction. I have a
No. Oh, I'm sorry. A VA scenario with a high DTI.
yeah, for sure. I want to bring that up too. This actually is a new construction, but not a construction loan. It's more of an end loan where the builder is carrying the cost. Then these borrowers are going to come in and buy it when it's complete. So it's just a more traditional loan in that situation. But in this case, you got two borrowers that had good jobs for as long as I've known them, and one of them got laid off, the higher income earner, and then she took a new job at a commission-based job, 100% commission. So we can't use her income at all anymore. It's going to be 2 years before we can use her income. She has no salary component. It's all commission, all variable, so we have to wait. So we're trying to do things off of the husband's income alone. He is a veteran. All right. What do you think, Beds, the maximum debt to income ratio is on a VA loan?
So I've seen this on the Mortgage Pub. I think I saw 76.
Yeah.
What,
I think that's the highest. I actually don't think there's a written down max, with like other loans, we know it's, 45 or 55 or something like that. I think it's whatever the system will actually accept, but I think I got this one approved with a 72% debt to income ratio which is great. Like they got their car because it's all on this guy. And I don't feel bad about it or scared for them because I know the other half of the equation, the wife does earn money. It's just not money that we can use for the type of loan that we're doing. But with the VA loan, we get his income. It covers car payments, all that stuff. They have some other investment properties. And when you do the math, it's a 72% debt to income ratio, which far exceeds what we'd be able to do with any other type of loan. And honestly, I'd be surprised how many loan officers even know that you can go that high or be willing to try to go that high. So it's one of those scenarios where these people have been under contract for this new construction for a while, been talking to them for a while, lose the job, panic. It's like, okay, let's take a step back. How are we going to get this done? And I'm like, well, let's use his VA loan now because we were going to go conventional before. And we made it work with a high debt to income ratio. And, things are moving forward, hopefully close in January, knock on wood.
Dude, amazing pivot. I remember you talking about that. So with VA loans on new constructions, the contractor needs to carry the interest payments for the borrower. How did they handle that? Were they okay with that?
It's not a traditional construction loan, though. So there might be some confusion on that because the guy's just building the house. And
it's end financing.
Yeah, it's end financing. So they're just kind of coming in, should be ready in the end of January. But it just takes a lot of stress off of them going into the holidays because it was one of those scenarios where we've been under contract for this new home. It's in a great neighborhood in Saco. What are we going to do? And now we know at least we can move forward. Already been signed off on by underwriting. I took the extra time to make sure that underwriting gave their blessing on it, the second level reviews, all that sort of stuff, and made it happen. So it's something that we can do.
Very nice pivot. Good for you.
I have another story if you would like.
Let's do it.
A little story time. So talking about debt to income ratio, there are some times where borrowers are just right up against what their max is. I have an FHA borrower, and they were right at that 50% mark. This is what their monthly debts are compared to their monthly income, and then you factor in the mortgage, and it puts them right at around 50% of their income. And their credit was like low, I think 622, and they didn't have much money. So it's one of those scenarios where we're running loans through this automated software we're talking about that Fannie Mae and Freddie Mac provides. Same thing for FHA. We have to run loans through this software, and it analyzes it, the assets, the reserves, the income, the credit score, and it gives us this initial approval, right? Factor in a gift that these people were getting. I had to run this loan. Me and Emily did it. She wanted to kill me, but Emily's our processor. Love you, Emily. But we ran it 37 times through this software to find a combination of down payment, gift money, reserves, everything that kept the debt to income ratio under 50, but still worked with the gift they're getting. I haven't had a loan like this probably in my career where just the slightest change of things would cause the loan to fail. But after 37 times, we found the right combination of things to make it work. And honestly, I don't know that anyone else really takes the time to do all that stuff.
Well, Randy Forcier does, no big deal. And Emily does. So let's do this. I want to guess what the trigger was. Was it the borrower had to have 2 months of their own reserves?
Yeah.
Yeah.
That
Dude,
was part of it, right? Because I've never seen it quite the way it is, where like we had to keep the loan amount at a certain amount to keep the debt to income ratio over 50, but we also had like this gift from the parents. But if we put too much of the gift in there, the system didn't like it because it wasn't the borrower's own money. So we had to find this like perfect sweet spot of DTI, cash to close, minimizing the gift to a certain degree. Usually there's only like one of these things where it's like, okay, I just got to get the debt to income ratio under 50 and it
yeah,
works. But like for this one, the reserves piece came into play. And reserves is how many months worth of mortgage payments they have in a side account, whether it's a retirement account, checking, savings, whatever. So we had to factor that into account to things as well. And there was money from a 401k too. And you look at 401k money differently at a 60% day. So me and Emily were like, oh my God. I honestly didn't think it was I didn't think we would find the right combination, but we did. And, things are moving full steam ahead.
so FHA is so sneaky. So good job with that. I had one like this before, and it was probably like 2 years ago. I remember how stressful it was trying to figure out where the trigger points were. So I closed one. So this is like the 620 and below FHA scenario. Probably about a month ago, I put somebody actually in your old neighborhood in my neighborhood, and that was a really really nice FHA loan. Large down payment. FICO score was sort of in that area where it's like sort of less than what you typically see in the approvals. So it was a little bit of a grind as far as paying stuff off, where we were going to shift some of the sale proceeds on the purchase, but we got it done. And I think, without getting too detailed about it, is that FHA is in the area with VA where it's like if you just get it to make sense with the down payment, you're going to get a loan done. It's just, dude, it's so, sometimes it just doesn't make sense to me what they take, but they're so heavily funded, they're so backed. It's just they get people in houses. So
Yeah, I mean, it's the government, it's the U.S. government insuring these loans. So, in my opinion, they're still the easiest loan to get qualified, despite these 37 times that I had to run through the system. Good stuff. Last thing I want to mention before we bring Uncle Tony in, because I get this question a lot, and I honestly don't know if we talked about it on the podcast before.
okay,
But borrowers ask me if they have to include their taxes and insurance in their mortgage payment, escrowing for taxes and insurance. People ask you this all the time. Like I just had someone ask me earlier today. They just assumed in this case that we weren't going to include those things for whatever reason. And we're actually closing next week. So I was a little bit surprised to hear that. But I kind of went through the whole explanation that, I typically default to including taxes and insurance in a mortgage payment because that's just typically what we do unless someone asks, then we can have that conversation. And then they were surprised to hear that Fannie Freddie actually adds an LLPA on borrowers that don't escrow. They add it's a 25 basis point fee that borrowers have to pay if they don't want to escrow. So in this case, I was like, if you don't want to escrow, it's going to be about $800 in additional closing costs to not escrow. And they were like, wow, I would have thought it was the other way around. But then I explained to them like, well, borrowers that don't escrow for taxes and insurance are at a higher risk of not paying their taxes or not maintaining insurance. So because of that, Fannie and Freddie institutes this 25 basis point fee. And when I tell borrowers this, most people just decide to escrow. It's one easier thing. But, it's funny how certain people think it's no big deal or would prefer to do that when all said and done.
everything's risk-based, baby.
Yeah, it's a risk thing for sure.
Yeah, it really is. And it's like usually 20% down is the trigger point to waive those, but still, it is a risk if somebody doesn't escrow. So you can see why the LLPA is there.
Yeah. So anyways, if you're listening to this and you don't know how that stuff works, just know if you are a borrower that doesn't want to escrow or you're a realtor working with borrowers that don't want to escrow, it's not us charging the fees. It's not a CMG thing. That's just a Fannie Freddie thing. There's an extra cost for borrowers that are not looking to escrow for taxes and insurance. And I think it's just easier, honestly, to escrow, but also people have been burned by their escrow accounts before too. So I guess it happens.
So
What do you think?
is it time?
I think it's time. Should we bring in Uncle Tony?
Yeah, let's bring everybody into my conversations. I can't wait to show Uncle Tony off to the world.
All right, cool. We'll take a second, then we'll be back with Uncle Tony.
All right, let's do it. All right, Uncle Tony, welcome to the show.
Oh, it's good to be here. It was so easy joining.
Super easy. We didn't just spend a half hour trying to coordinate this. I do want to give Bed some public credit for winning the IT Award of the Month. Made this happen. Had the suggestion. I got Uncle Tony on, so we did it. We're here. Let's go.
Now you're making
Everybody-
good luck.
I know, right? Everybody needs to know that Randy consistently picks on me about my technology stuff. So His acknowledgement here, it means a lot. So, Uncle Tony, welcome. So, I would love to start sort of a little bit with your background, your history in finance. And I think I want to go down the rabbit hole of what do you think the economy is going to do the next year or so, how it's going to affect real estate, interest rates, et cetera. So, why don't you introduce yourself to our listeners?
All right. Well, great to be joining you and joining your listeners. So, yeah, my background is maybe different than some of the folks that listen in. I spent about 3 decades in banking, most of it in consumer banking. So, kicking around all the consumer products that everybody uses, including mortgages, including auto loans and credit cards and retail banking. I was with Citi at the time, spent time both in the US and internationally, most of it in finance, but also in product management. So I have a lot of background in the type of products that you guys deal with every day. I let little dribs and drabs of that out to Chris every once in a while, or beds, I guess you're known as on this.
Beds.
Beds, okay.
He references you at least like twice a day, just so you know.
So that's it. I'm happy to join in the conversation. Maybe I can offer an opinion or two.
Well, for me, it's interesting because, following MBS Highway, it's just been simply following charts, watching money flow out of stocks, going into bonds and vice versa, off of economic data. Where do you sort of look when you're, analyzing what do you think the economy's up to? Where do you think it's going?
Yeah, I think a great place to start is look at the rate curve. And the rate curve is looking at where interest rates are given the length of time until maturity. So when you talk about the Fed funds rate, that's overnight money. That's money that's due tomorrow. And that's the rate that the Fed sets. And then, of course, you have 3-month treasuries, 6-month treasuries, 1-year treasuries, 20 all the way up to 30 years. If you look at the shape of the rate curve, it tells you a lot about what the anticipated economic activity is. So let's say a vibrant economy, you're typically going to see some sort of slope where the short-term rates are a bit lower than the middle-term rates. I'll call that 5-year money. And then the longer-term rates, 10-year and beyond, are yet higher. That would be a typical rate curve that you would see in a well-balanced economy. If you see a rate curve where short-term rates are much higher than longer-term rates, that's usually an indication of an upcoming recession. That's the infamous inversion of the rate curve that everybody's talking about for the last 2 years.
When did we get to that?
I'm sorry?
When did we get to the inverted rate curve?
It was about 1.5 years ago.
Yeah.
And we just uninverted. So if you look at the rate curve presently, it's very flat. And as I mentioned before, the Fed funds rate, which is the very shortest end of the rate curve, is what the Fed controls. So when they drop rates again, as they're expected to either in December or January, we'll now see for the first time in over 1.5 years where short-term rates are in fact lower than middle-term rates and high-term. So the other thing that, sort of should mention along the way, when the Fed changes rates, it only changes rates for overnight money. It has no impact on 1-year money, 5-year money, 10-year money, other than signaling what they think is going to happen in the economy. They don't control the 10-year rate, which means by definition, they don't control mortgage rates, fixed rates. They might have a bigger impact on an ARM, adjustable rate, but not the longer term rates. And in fact, after the last rate cuts, of which we've had 2, the long-term rates have actually gone up, not down. So, and I would say the yield curve is normalizing. This is probably now where we sit, fairly indicative of where the economy is. And so, answering your question, where would I look? I'd look at the rate curve.
Yeah.
And that rate curve is telling me a relatively modest growth economy. It should not be growing in a way that it's stoking tons of inflation, although there's other things that can stoke inflation, but economic growth is one of them, and you don't see that signal. You don't see a signal of a slowdown. So it's very much a steady as she goes kind of rate outlook right now.
Did we avoid a recession?
Did we? Well, we had an event about a year and a half ago, which was always the classical definition of a recession. We had 2 consecutive quarters of negative GDP growth. It happened. Everybody rushed to the table to explain that's not really a rule, and we don't have a recession, and such it was declared. So I guess, yes, we did, based upon the people that officially keep score, and you have to throw that rule out, which then I'd have to call back and say, well, then what is a recession if it's not that? Let me say one more thing about a recession. The idea that it's two quarters in a row of negative growth, is there really that much different between a negative 0.5% and a positive 0.5%? So an economy that's moving very, very slowly can certainly feel like a recession in pockets of it, because it's not such a hard and fast rule. Now, if you're in a very steep recession, I think it's pretty obvious to everybody. And so I think we may have had a mild recession, although it was canceled, but nothing significant.
Randy,
It's funny that you bring that up, though, because the inverted yield curve is always a sign of recession, right? Isn't it? Like, it's never not a sign of a recession. Like, I don't know what the percentage is that's right, but that would make sense that we did actually touch on a recession if that was.
That's close. I mean, so what is true is that you never have a recession without it being preceded by an inverted yield curve.
Okay.
But you don't always have a recession every time the yield curve inverts.
Yeah.
So it's not, it doesn't necessarily cause it, but it's typically there before one happens.
Mm-hmm. Can you speak to the way mortgage rates reacted to the Fed funds rate being cut? Do you mind sharing some insight on that? I think some of our listeners might be interested in that.
Let's stick with the typical fixed rate mortgage. So let's talk about the typical conventional fixed rate mortgage, and then you can always make adjustments based upon product. So you've got to go back to what I said before. The Fed funds affects overnight money. The conventional 30-year fixed and the conventional 15-year fixed tend to follow the 10-year Treasury rate. Mm-hmm. So when the Fed changed rates, they changed overnight money. That does affect things like prime. It does affect things like some credit card rates, but it does not affect mortgage rates. Sometimes the long rates will move in conjunction with, and sometimes not. So if they don't move by the Fed funds rate, what do they move with? And a good benchmark, all other things being equal, and I'll come back to that, for the 10-year rate would be inflation plus a rate of return. And the typical rate of return you should expect is about 2%. So if you look right now and say, where's inflation? The numbers are reading somewhere around 2.5%. Yeah. If you add 2%, you get to 4.5%. The 10-year right now is 4.40. So it's very much in line with that. So it's going to move based upon expectations of inflation. Now, you could argue the Fed funds rate is being lowered when inflation expectations are low. And so therefore you could make a probable linkage, but realistically it's inflation expectations plus 2. That's normal. Yeah. So that's going to give you the 10-year rate. Now I said that mortgages are then based upon the 10-year rate. If you want to get to an expected 30-year mortgage rate, add 2% to the 10-year Treasury. Mm-hmm. If you did that today, it'd be 6.4%. You guys know where the 30-year mortgage is. Now, sometimes everything else is not equal. So if you dial back about a year and a half ago, maybe it was 2 years ago now, when we had historically low mortgage rates, and you went through that arithmetic, it would have said, gee, those mortgage rates should be a little bit higher. They shouldn't be low threes. They should be high threes or maybe 4.
Yeah.
Well, what was going on is the Fed was buying MBS. They were buying them like crazy. And so there was a lot of demand. So that pushed the price down. I'm sorry, it pushed the rates down, put the price up. And so you have to factor those kind of things in. But if you said today, what does the rate picture really look like? I would say it looks sort of like the classical model. Expected rate of inflation plus 2% gets you to 10-year, plus 2% gets you to 30-year mortgage rate.
Yeah. Yep.
And if you look historically, rates are about where they've averaged over the last 30 years, mortgage rates, I mean.
Yeah.
And so anybody looking at mortgage rates today, I would say they look very normal. They look very normal for the series of facts that I laid out. Now, if inflation expectations go up, you should expect the mortgage rates to go up.
Mm-hmm.
If they come down a bit, it should come down a bit. But the concept that you need to make a rate of return on money, it sort of got lost a little bit in the post, financial crisis era. And then it got perpetuated for quite a period of time, which is probably why we won't see, mortgage rates with a 3 handle in the rest of my lifetime.
Yeah. So it really was a unique set of circumstances with the Fed buying mortgage-backed securities in a way that's not happening again anytime soon.
Well, it started with, even negative interest rates on some tenors, which was crazy. And it persisted for a long period of time. Yes. And then it got combined with building the balance sheet and also very low inflation expectation. So all the arrows were going the same way. Now it looks normal.
Yeah. It makes me concerned that borrowers have expectation that rates are going to go. Obviously 3 is not going to touch that, but even the 4s and 5s seems out of question when you do the math on what you just said. Because what's the Fed's inflation target? Is it 2%? Like where do they want inflation to be?
They've been saying 2. They've been saying 2. And, so 2 plus 2 gets you to 4, and then you got to add something for the more. And why do you add the 2? You could ask, why do you add the 2% for a mortgage? Well, the reality is to do a mortgage, you've got to come up with the cash to make the mortgage. Somebody has to come up with the cash to make the mortgage, the investors, and they want a return on their money. I mean, that's just the way it's going to work. Yeah. And again, if you look historically, 6 to 6.5% is not a high mortgage rate. No. If you look at the data, it will tell you that what was unusual would have been, 2001, 2021, 2020, that time period. Yeah. That was the unusual time period.
The thing that I think is tough for borrowers now is that I agree rates are very normal when you look at the bigger picture, but the thing that just hasn't kept up for people is their wages. They're just not earning as much as they did, 10 years ago, 20 years ago, longer compared to what rates are. So it's tough. I mean, I see a real affordability problem for people right now. 6% might be normal, but the mortgage payments, they're a lot for what people make.
Well, and it's a bit of a, it's actually more than that because the asset itself is appreciated so much.
Yeah.
So you have a hard double on the value of the property. And then you add on top of it, which people could live with when rates were in the 3s. Mm-hmm. But now you push the rates back to more of a historical norm. And now you're really dealing with the fact that your payment is doubled because the value of the real estate is doubled. Yeah. Or tripled in some cases. And that's the rub. The real earnings have not kept that pace.
So I begin to wonder, are we heading towards an area where more inventory is going to start popping up? I think you've mentioned it to me in the Florida area. You're starting to see things sit a little bit longer, which finally puts some downward pressure on things. Randy and I are starting to see a lot of price improvements or corrections in our area.
Price
Can
improvements as long as you're not the seller, I guess.
Yeah, I know.
The sellers are swinging for the fences with some of the prices that they're listing at right now. So I guess
Yeah.
it's inevitable that some of them are going to have to come down. But we are definitely seeing more and more of that.
Yeah. There's definitely, a change in Florida for sure. I mean, prices are they stabilized and now they're actually declining. Setting aside the coastal areas that have their own unique set of issues because of all the flooding. But yes, it's definitely moving in the other direction.
One of the things I get concerned about is the fact that people no longer sell a house to buy a house. They all retain their home, rent it out, and buy another house. And we live in this Airbnb world where it's easy to just be a landlord. And, there's probably a million other things, but it just seems like that normal flow of like, I buy a house, I'm going to sell it, buy another one, sell it, buy another. It just doesn't happen quite like that anymore. It's really perpetuated this inventory issue that we have, among other reasons. And I don't know that I see the inventory issue getting better anytime soon. I don't know. Do you have any thoughts on that sort of thing?
Well, as you guys well know, all real estate markets are local. So, whatever I would say about Florida may not apply to, Southern Maine. I don't have that. I'm not close enough to it to know how that plays through your market. It probably depends on what category of house you're talking about. And, the market tends to be split into different segments. So, what's happening on the top end may look very different than what's happening in the entry level.
Yeah.
And so I just don't know the market there well enough to know whether that inventory is going to, whether it will start to free up somewhat. I'm sure that's what's causing some amount of the freeze in the inventory is all the folks that do hold these 3% mortgages are less willing to give that up, because it's one thing for someone to say, well, I'm ready to leave my starter home now and I want to move to a bigger place. And I can afford a more expensive or an upgrade. Then you factor in the cost of money and it's like, oh, I can't go there now because, and so I'm going to have to put an addition on. I'm going to have to remodel. I'm going to stay where I am because I don't want to give up that 30-year mortgage at 275.
Rand, I'm starting to wonder. A couple of months ago, I read an Airbnb report about some of their sales numbers. So they were down year over year. I talked to a couple of the agents that are out in the Lake Arrowhead area, out in Waterboro. Some recent inventory starting to sit after like years of properties going on the market and all of a sudden selling 5 minutes later, bidding up. In certain cases, retail sales and manufacturing recently sort of stagnating. So I'm wondering if we're finally starting to hit the area, depending on the area, where some people might be willing to let go of some of those properties because they're not producing as much as they used to. I think it's part of the equation or the conversation now because it's starting to happen. So I'm wondering if that pushes on inventory a little bit more than it has the past few years, helping us out a little bit.
Yeah, fair enough.
If you and I have talked before, Chris, I refuse to call you Bed, sorry. That real estate transactions tend to be life cycle event driven. And life cycle is not stopping.
Right.
Marriages aren't stopping, family formations aren't stopping, people retiring, downsizing, it's not stopping. And so all of those trends will continue and the market will normalize. It's going to take a while, just like getting to some sort of normalized understanding of where rates are. It takes a while, but we'll get there. And there will be a time where you'll be on this podcast talking about the inventory glut. Yeah. It'll happen.
And it always does. So I feel like we could talk to you all afternoon, but we know the attention spans of humans' minds these days. So I think we're going to kind of cut it in this area. But I want to talk to you all afternoon. I'm glad Randy finally got to meet you. A thought that I'm having is that maybe we'll do this again in the future.
Yeah, I would love to.
Well, listen to your listeners because they'll tell you whether they appreciate it or not. I'll let them decide.
Okay, fair enough.
I really enjoyed that math that you did with the inflation, the 10-year, the mortgage rates. That makes sense to me in a way that I don't know that I quite thought of before. So that's great information. I appreciate you sharing all your knowledge. So thanks for coming on.
All right, guys.
That's Uncle Tony.
That's Uncle Tony. I'm very fortunate to have his conversations. We talk sports all the time, but man, he mixes in some of that economic stuff, and he's really polite with me where he just gets me to an area. But as you can see, he could just talk all day about it. His technical factors, you could tell he dominated in his career. So
yeah. Well, we're lucky to have him on because I very much appreciated just how calm he was, straightforward, just good at explaining things. And I think anyone that's listening, I probably got some value out of it, learned a little bit more about mortgage rates, what the federal funds rate is, how all that stuff works, how inflation factors into things. So it was a great conversation to have. We've been having variations of that conversation for a while now. But to have someone with his experience have it again with us was awesome.
Yep. Yeah, that was a good pod, Rand.
So thank you to anyone that's still listening. We appreciate the support. Please know me and Beds are happy to help anyone that you know that needs a mortgage, whether that's you or someone that you're working with. We're always happy to help.
Thanks for listening, everyone.